Hello, and welcome to another episode of Freedom Ain't Free. In today's video, we're going to be talking about which is better, stocks versus bonds. And our ultimate goal is to get you to financial freedom. As I talked to my clients over the past couple of weeks, and we've kind of gone through the turbulence, markets up and markets down, as we've seen gold prices spike, as we've seen challenges in our consumer goods. We've been having these conversations about which is better, stocks versus bonds, and what's going to ultimately get me to where I'm trying to be, which is financially free. Now, the interesting thing about the overall thought process is we got to have a deeper conversation than that, right? So if you're a Henry, a high earner, not rich yet, you figured out how to make money. You figured out how to create income, but you haven't quite figured out what to do with the money, now that you have it. So, it's a lot more to it than just understanding the stocks versus bonds. So in today's video, I'm going to give you the 7 steps that you need to work through in order to maximize your portfolio. Now, I want to encourage you, stay all the way to the end. I got a surprise for you, a little bonus that we put into today's episode that we're going to give just to you. Step number 1 in the process of maximizing your investment portfolio is be honest. You have no idea what you're doing, right? You're investing, you're putting money aside, and you're hoping those dollar amounts are going to get you where you want to go. But in reality, you have no idea what you're doing. So you got to get some wisdom, some knowledge, and some understanding in order to be able to differentiate. Should you have a stock portfolio? Should you have a bond portfolio? Should you have a little bit of in between? Trust me, your human resource manager has no idea how to invest your money. So we want to encourage you to reach out. If you want to connect with us, there's a link in the video below. We'd be glad to get with you, get you your freedom number, and share with you some information on how you can get to financial freedom. Number 2, let's talk about understanding risk. That's the biggest piece of the puzzle. How long are you going to continue to invest without understanding the risk? The big piece of the puzzle when you look at risk is how quickly can you recover? We all understand how the stock market works. I'm supposed to buy when it's low, and I'm supposed to sell when it's high. But in reality, that's not what we do. We get really emotional when the market starts to go down. We get really scared. And the reason why we do that is because we don't understand the risk. If you have all of your money in a stock portfolio where you're buying equities and you're buying in an ownership position into a company, but you don't know anything about the company, you don't know anything about the fund, you don't know where the fund's investing, you don't know whether it's working just in America or is it international, you don't know what sectors it's in, you may not even know what those words mean. So when you start to see what you think is your balance going down, you get emotional and you sell out of the positions that you're in. When you begin to understand how risk works, then you have a clear understanding of how the market adjusts and when you're making money and when you're not making money. So first thing we got to do is we got to get a clear understanding of that. The second thing we got to understand is our time horizon, right? Are you 25? Are you 35? Are you 45? Are you 55, right? When do you want to retire? When do you want to be financially free? By the way, financial freedom has absolutely nothing to do with age, has everything to do with, do you have a $2 million portfolio that you can live off of? So you got to understand your time horizon. Are you trying to get there in 5 years? You're trying to get there in 10 years? You got 20 years or more? Well, the longer window I have, the more risk I can afford to take. Shorter window I have, the shorter risk I can afford to take. If I got a bond portfolio, a bond is a loan to a company. Company's going to pay me back plus guaranteed interest. Well, typically your bond rates are going to perform at a lower overall average than your stock portfolio, but it takes on a lot less risk. So if I'm closer to that time frame, right, if I'm sitting on, $1.2 million, $1.5 million, right, I don't need to take on as much risk as somebody who's sitting on 100,000 or 50,000, right? If I've got a 5-year window, I can afford for the market to adjust and cost lose 20% of my portfolio. I'm almost to the finish line, right? If I'm at the beginning, I got 20 plus years ahead of me. I've got more time to rebound and to pick back up. So I can take on more risk because I understand my time horizon. The next thing I want to talk to you about is basically the difference between the stock and the bond. A stock, again, is equity in the company. You're buying into the company. So if you buy a mutual fund, which is where most of my Henry clients are doing their investing, mutual fund is a collection of either stocks a collection of bonds, or a combination of the two. You may be in a target date fund in your 401k where, part of your portfolio is stocks, part of your portfolio is bonds, or you may have it the other way around. But the stock is buying into a company. So if you're investing in mutual funds, you own a share of the fund. The fund is buying individual stocks and individual bonds. So the bond is a loan. You loan money to the company pays you back, plus they guaranteed you some interest. And so depending on what type of bond you buy, what type of stock you buy, one has a lot more volatility, that's the stock, but a greater opportunity for gains. One, a lot less volatility, but a lower opportunity for gains. So if you understand the combination of the two, you want to have a little bit of both in your portfolio, but you need to have a properly diversified portfolio. So I promise you, stay to the end and you're going to get a nice bonus that we're going to share with you. So understand the product, right? Do I need more stocks? Do I need more bonds? How do I balance out the two pieces of the puzzle? The next thing you got to realize is, how much does it cost? You got to understand the cost. So mutual funds have fees, right? And you got to understand how those fees work. I don't mind paying fees, right? I don't mind paying fees. But if I pay a fee, then I want to get a service above what I could get for a lower price. So understanding that, if I look at the mutual fund, this particular mutual fund may be, hitting this type of return at this cost. This mutual fund may be hitting a lower return, but it's got a lower cost. So I'm actually making more money. You got to understand the cost in your overall investing strategies, because that goes into play in your time horizon, and it goes into play into your risk. If I take on more risk and I'm paying a higher fee, then that particular investment part of my portfolio has got to perform at a much higher level just for me to break even on some less riskier, lower cost investment strategy. So I want to encourage you to join us in the Financial Freedom Institute, where I give you all the wisdom, the knowledge, and the understanding that you need to understand how all of these things come together. Check out the link in the description below. Join us in the Financial Freedom Institute and get what you need so you can get financially free. The next thing I want to talk about is bracing for the impact. Bracing for the impact. We know the markets are going to go up. We know the markets are going to go down. We have to have that as an expectation. If you're checking your account every day, which I don't encourage you to do, but if you're checking your account every day, understand sometimes it's going to have a bigger number, sometimes it's going to have a lower number. But until you sell your shares, nothing has happened. Let me say that again. Until you sell your shares, nothing has happened. You really haven't made any money, and you haven't really lost any money, because in order for you to capture a gain or to capture a loss, you have to sell out of your position. So only thing that happened is your position changed that day. If you didn't take advantage of it, or if you didn't move your money, you didn't really lose any money. You really didn't make any money. But you got to brace yourself for the impact. Understand that you're going to have days when the markets are going to be higher or lower. You cannot control the economy. You cannot control Washington, D.C. You cannot control the things that happen in the rest of the world. What you have to do is use the other strategies. Put yourself in a position to get you where you want to go. Once you built out that $2 million portfolio, now you have a different strategy altogether. Now I'm switching from accumulation to wealth, and I'm switching from living off my labor to living off my assets, and I want a completely different strategy once I built out that $2 million portfolio. So you got to brace for the impact along the way until you get to the freedom line. The way you brace for the impact is by using a strategy that I like to call capping. Right. And here's what I mean by capping. Every time I get to $250,000 or a new $250,000, I'm going to slide that over into a category where I can't lose money and it can't go backwards. Yes, you can invest in the market without losing money on your market gains. There are strategies out there that allow you to grow your money, invest your money without actually taking on a risk with your principal. And so you can utilize those strategies, cap out. That $250,000 cap. Now I'm gonna move on and I'm gonna start gaining. I'm working my way to the next $250,000. I'm gonna cap that out and I'm gonna keep on going until I develop that $2 million that I need to get financially free. If you can get an 8% return on a $2 million portfolio, it's $160,000 a year coming from your assets, not coming from your labor. Most of my clients would be financially free, right? And those are the strategies that we teach here at ARC Financial Strategies in the Freedom Ain't Free channel. We want to make sure that you get the wisdom, the knowledge, and the understanding in order for you to get financially free. And the very first thing that you need in order to do that is you got to get your freedom number. You got to get your freedom number. Your freedom number is going to tell you specifically how much money you need to save each and every month in order for you to get that $2 million portfolio and get to financial freedom. And here's your bonus. There's going to be a link in the description below. You can get your freedom number for free, right? That's it. I'm going to give it. I'm going to give it my secret sauce completely free. Click on the link down below, and that's going to take you to a page where you can get your freedom number. And once you know that, you know exactly how much money you need to save, now you can go in and make the financial decisions that you need to make to get you where you want to go. We want to encourage you. Get the freedom, the wisdom, the knowledge, the understanding that you need to be successful. And the best way to do that is by getting your freedom number and joining the Financial Freedom Institute, where you can get all of the information you need. You can watch the videos over and over again. Join our VIP and our masterclass, and we're going to help you get to where you can live your life on your terms, where you can go and do the things that you're passionate about. We appreciate you spending some time with us today. Looking forward to seeing you in the next episode. And remember, freedom ain't free.